over time, you kind of have to build up your intestinal fortitude. And in 2020, I was working with numbers that I hadn't worked with before. All of a sudden now I had a $1 million account. Now it's 10 million. Okay, let's wire some money out. Now it's bigger. The
Yep.
price of 100x is you got to be able to withstand 70% volatility. That means like, if you're going to be a long-term holder of Bitcoin, the idea that this thing's going to go up 100x, of course, this was a while ago, the price you have to pay is 70% volatility, meaning that those are the drawdowns that have to happen if something's going to go up 100x. Once you have a setup and put your trade on, just get out of the way. Otherwise, you're just going to ruin it. I would say just do what you're comfortable with. I think it's okay to push your size. If you normally trade 1,000 shares, try a trade with 2,000 shares. See what that's like. Okay. Does it freak you out? Great. Go back to 1,000 shares. But now that you've experienced that freak out moment, trading 1,000 shares is going to be a little bit easier because you kind of just expanded what you felt was uncomfortable. It is once every couple of years or over the course of any given year, there's maybe 2 days every quarter where you have the opportunity to make these really big gains. And
Right.
so you just have to be there. You have to be there. You have to be present to win. And you just want to make sure you're not trying to extract these huge gains from the market when the market isn't playing that game.
All right, welcome back everybody to the TraderLion podcast. I'm your host, Richard Moglen. This is brought to you by DeepView as well as the Ultimate Trading Guide. Joining us today is someone who I've really been wanting to talk to for quite some time. John Carter is a full-time trader since the 90s. He's the author of Mastering the Trade and the founder of Simpler Trading. John, really looking forward to diving into your style, discussing options, the ups and downs of trading, risk management, all that good stuff. So thank you so much for taking the time, and really looking forward to this.
Yeah, and Richard, thanks for inviting me and having me on this. I think it's great, what you've put together here, and I love how as this, I've progressed through this industry, just the ways of sharing information have kind of grown and kind of made it more accessible to people and having some real conversations. And so, yeah, kudos to you for putting all this together.
Yeah, it's awesome for me to get you to ask you questions and for everybody in our audience to join in. So yeah, let's go ahead and dive right in. I like to start usually from the very beginning to hear your kind of origin story, if you were. And I believe it was maybe your father who first got you interested in trading back in high school. Can you kind of tell us about your first experiences in the markets? Did you love it? Did you hate it? And how kind of all that went?
Yeah, no, for sure. And it is probably like the best worst thing that could happen. So, as a senior in high school, absolutely no clue. Either what I was doing, what is the stock market? And my dad, some of his buddies were sitting around talking about like earnings and Intel and options, and it kind of caught my interest as I was walking by. It was toward the end of a summer where I had spent the entire summer working at the mall at this cookie store, making $4.25 an hour.
Yep.
And so I'd like made $1,000 over like 3 months, and like, all right, money to burn. So I just said like, hey, this is interesting. I'd like to do it. So the short version is, one of the guys spotted me. Like I gave him the money. He bought like 10 calls in his account. And then, 2 weeks later, he came back and gave me, my $1,000 and gave me another $800. Okay. At that point, I was hooked. So I didn't know what an option was. I didn't know what Intel was, but that just kind of started me on the journey of, I could make money with like my ideas
Right.
versus, per hour.
Right.
So that was kind of a huge thing. And that kind of kicked off this really an 8-year journey through high school where I had some amazing wins. Like I put my mine and my now wife's tuition money into the stock called iOmega. I mean, it just exploded. And I was using Investors Business Daily then and kind of going through, and I found that one, using the IBD newspaper scan. And then from there I went in the corporate world and pretty soon kind of recognized that, corporate I it was a unique experience because I worked for this company for 2 years in the field where I was like hiring and firing people and responsible for a profit and loss statement and really trying to grow an enterprise. And then I spent 2 years at the headquarters, which was a very Dilbert experience. I was just
Mm.
like, but I loved that experience in the field. And that actually later helped me when I decided to start Simpler Trading because I had the experience of really, truly running a company. And at the time, I didn't know that that was going to be such an invaluable experience, but it certainly was. But while I was working, I was really kind of getting on the idea of like I need to be able to trade, for a living.
Right.
And up to that point, I had some boom and busts. I'd have $10,000. I'd take some incredible risks, looking back on it. And run it up to 100,000. And then usually at that point, what I would do is I'd take some money out and I'd put it in real estate. And then I'd like, all right, now let's, run the rest up to 1 million and, I'd blow it up. And the worst case of this, and I talk about this in Mashing the Trade, is like I had set up this point where I had about $150,000. I was doing some trades in the OEX options. I was working full time. And, I was kind of like, I was trading more conservatively. I was making a couple thousand a week. And I was like, man, we could live on this. And about that time, my wife and I decided like we should buy a house. And the short version of the story is that, we found a house and we're going to take the down payment out of my trading account. And so I put on, about a week before, I was like, man, I don't want to take like 40 grand out of my trading account and then, take it from 150 to 110. So why don't I just do like a big trade, run my account to 190, take out the 40, buy the
Mhm.
house. You got to buy the house when you still have a job, and then I'll have my $150,000 account. And man, this is gonna be great. So, man, I loaded up on all these OEX puts. I'm looking at the charts. Here's the trend line. And the day of when the markets closed, I was up like 10 grand. So I'm like, oh man, we'll get a gap down. This is gonna be good to go. And then the next morning, I mean, the markets, like the Dow gapped up hundreds of points. And this is back when the Dow was nowhere
Yeah,
near,
yeah.
what it is today, right? And it just went up 4 days in a row. And I was just like, and I don't even honestly know why. Like I just didn't know what happened. Obviously, some report came out, or I don't know. I don't even know what it was. But the weird part of all that is I just don't really remember it. But I do remember that, I needed to close my positions out like 2 days before because I needed to buy the house. I went to close the positions out. My account went from 150,000 down to 8,000. So I
Oof.
didn't even have enough money to buy the house. And I was like, man, I cannot tell Maria what just happened. So, I went to the bank and I maxed out all my credit cards and got cash advances to put into my account. And then we went to the closing the next day and everything went fine until they kind of said, like, well, you said the money was going to come from here and it's coming from here. And, we need to see where this money came from. At that point, I thought the gig was up. And so I just played really stupid. I'm like, what? And I just, for half an hour, I was just like, I don't understand, what's going on here. And finally, they just got frustrated and gave us the house. Um, but after that was done, I went to a golf course and I played like 9 holes. I think I threw up once, but I was in this state of weird kind of shock. But the what happened at that point is I stopped trading for a while. I had some real estate that I bought, and I had to really make a decision. And I found Mark Douglas's book, Trading in the Zone,
Yeah.
and we ended up working together. Like he was a mentor for me. We talked a lot right up until his passing. And um, what I really learned from that is just the idea of you just need to really, find the setup and make sure that you're being present and not trying to work out your childhood trauma, onto the markets. And if you focus on that, the money will come. But if you try to make money, you're just going to be an error-prone, moist robot reacting to stuff and it's not going to work. And so that kind of set me on the path to kind of where I got today. And so it was an excruciating experience I wouldn't wish on anyone, which is kind of what motivated me to share. Like, all right, you don't have to go through this. But at the same time, it was also, a priceless experience.
Yeah, a lot of good lessons for newer traders out there on what not to do there. But I completely agree with that, and I love that. I'll just make 40K to pay for the house next week. That's no
Yeah,
problem.
no
No
problem,
problem.
right?
No problem. Yeah. At that point, what was the trading style that you were using? Is it similar to what you're doing now, or obviously you've developed it, and refined it over time? But what were you kind of doing at that point? Was it mostly options?
Yeah, so there's definitely options. I was not using tools that I use today. And it was more, it's kind of like, okay, the market's going up and there's a trend line. And, and I might, so in this case, the one that blew up, we were coming up against a downtrend line. So I just thought it would hold,
Right.
okay. So that was kind of the main thing. Or, I'd look at stocks on IBD and a lot of times wouldn't necessarily look at a chart. I'm like, okay, E-Trade. Well, I guess I'll buy some calls. And I would always go in the money and give myself time, but my
Yeah.
timing was, there was no really timing. It was just I like it, so I guess I should get it.
Yeah, perfect. And Mark Douglas, obviously, you mentioned you learned from. Were there any other key resources or mentors along the way that you really took some valuable lessons from? And is there anybody who comes to mind?
There are definitely some people along the way. Mark Douglas stands out the most. From there were a couple of books, that I'd read, some of the classic ones. I really liked Nicholas Darvis, How I Made the 2 million in the Stock Market. And what stood out there is just the idea of how staring at charts and interfering with what's happening, how that really ruins the process.
Right.
Once you have a setup and put your trade on, just get out of the way, because otherwise you're just going to ruin it. And that really stood out. There was another one, I think it was Jack Schweiger, and it was Hedge Fund Wizards.
Yeah.
And I like that because of how much they really talked about, everybody in that book really talked about asymmetrical risk, in terms of, don't bet it all on this, or, really looking at like what goes wrong. And I take big risks in trading, but, I always want to, like, I can't really sleep unless I have a lot of positions on. It's like, uh, although I always say that the true spa treatment for a trader is to be flat from time to time. So I
Hmm.
do try to do that. But I like the idea of like knowing that, okay, if I have a lot of exposure, so maybe I'm, locked and loaded on long calls, on six positions. But if we're a little toppy, I might buy some puts on the SPX just so like when I wake up, I don't want to wake up to a shit show
Yeah.
kind of a thing. And so, but I say that as a caveat because I've also believe in long-term putting money in indexes. And I don't do anything with that. I just leave it. And it's done great. Even I just keep putting money into it. And so what's kind of amazing with that is how you can put a lot of effort into something and a lot of angst. Um, or you kind of have something like this that really doesn't care about all that. And so I
Right.
always try to, keep that in perspective as well.
Yeah, the $2 million and how I made $2 million in 18 months. That's one of my favorite books. It's usually actually back there, and I think along the lines of what you said. My favorite quotes from that is, he says at some one point, "I decided to let my stop loss decide," and that moment of clarity of just letting that line in the sand work itself out, let the stock do what it wants, let it trend. I think that there's a lot of depth there. So completely agree about that book. Um, yeah, were there any other key books in mind that also helped you? Obviously, Mark Douglas's book Trading in the Zone you mentioned, but were there any other books that you'd like to recommend if a nephew or a friend said, "Hey, I want to get into trading"? What would you kind of recommend them to start with?
Well, I'm definitely a huge fan of William O'Neill's work. And when I was learning to trade, I would go to a lot of the IBD seminars, Investors Business Daily, with his work and his books. To me, that just really made sense. And not
Hmm.
only if you're going to do a stock, longer term, but I love some of the examples. They would show examples of stocks like Home Depot and things like that. Like, what does a winner look like?
Right.
and and just the idea that if you're in and every stock goes through periods like this, and Microsoft is a great example where for the period of time it did nothing, for a
Hmm.
long time, from 2000 to whatever 20, even like 10, 15 years it did nothing. But prior to that it had this like 5-year explosion in price, and then of course more recently it's had this explosion in price. And I love that they really talk about how to narrow that down. And I'm certainly into technical analysis and not really so much on fundamentals. But if the fundamentals are right, the technical analysis doesn't matter.
Right.
And I always say, like, like Nvidia is a good example. 2 years ago, pre-split, it was a $122 stock. When the valuations and the fundamentals on that stock changed, all these overhead resistance levels that we all have, Bollinger Bands, whatever they don't actually exist in the real world. And when a company is being revalued, none of that stuff matters. And so I think that really taught me that if you're in a company that's being like revalued, don't sit there and try to time it and jockey it. And I'm certainly a fan of, let's buy a stock and, it pops up and sell it, that kind of stuff. But, there are companies out there you just want to own for periods of time and don't overanalyze like, oh God, it seems like it's overbought here, and then you get out of it and then you just, you can miss an entire run.
Yeah.
And so I think it's important. And that was they were the first. He was the first guy that really said, kind of showed me that. And I remember this was something that, and I don't know if this is a public story or not. I was at one of his events and talking to someone that worked there, and I kept asking about asset allocation. And the guy was like, "Look, if you got a good company, if there's only three good companies out there, those are the ones you buy. You don't need to diversify across 20 companies." And he said, "Well, and Bill William O'Neill." He said, at one point, the only stock, he had one stock in his fund, and the fund was 100% of the stock,
Yep.
Amgen,
Yep.
because that was the only stock that was coming up that actually hit all these things. And I thought that was pretty powerful too. It's like, hey, if you just own the best stock and, don't worry about it. Just, there's a saying in trading that I like, don't anticipate, just participate. And
Yep.
that was a really good example of that.
Yeah, Ross Haber, who is one of the other co-founders of TraderLion, he worked as a portfolio manager for O'Neill for a number of years, and he's told us stories many times where O'Neill would be 200% long in one or two names, and because
Yeah.
that's what he had conviction in, he managed risk on his entry and just let it ride, added over time, and that was his style, and that's what kind of he found worked best for him, and obviously he had tremendous success. For you, I know obviously a lot of the same principles apply, but you compress it to much shorter time frames. Do you mind kind of talking about your overall style, the time frames you like to trade, and how you utilize options as well? Because I think a lot of our audience primarily trade shares, but
Okay.
obviously it's kind of the same thing at the end of the day, or
Yeah.
similar.
So, yeah, no, that makes sense. And so the setups that I use, so I'm not really heavy into like what I would call the option Greeks. Like, I don't really care like about Vega. I know they're important, but the way I trade, it doesn't really matter
Right.
with that stuff. And so I look at the underlying chart pattern. And then I also, a lot of the stocks I use are from Investors Business Daily. I like all their lists. And so I have specific patterns that I'll look at on those stocks. And I, at some point, if you want to share charts, I can show it. But
Yeah, that'd be
it's,
great.
I look for compressions in price. It's kind of like a volatility squeeze.
Yep.
And, if a stock's gone up for a while and then it's just kind of stopped moving and it's compressing in price, that's what I look for. And the whole options market is based on, I would say 75% of the time a stock moves within what's called an expected range. And then about 25% of the time you have a greater than expected move. And that's just where a stock is, normally it may be trading in a range of $3 to $5 a day. And then suddenly it's up 8, 9, $10. And that's where you really get a bang for your buck in options because options don't price that in. They just price in that smaller move. And so, my favorite trades are something along the lines of, okay, we got this huge, we have this consolidation. Now, let's buy some options that are 30, maybe 60 days out, and then let's just ride this out and let this unfold. And so my philosophy there is to kind of play these pops in stocks and then get out and then go look for the next consolidation. So
Mhm.
maybe I'll do one in Google, and then, the next one might be in something like Goldman Sachs.
Right.
So it's just kind of going from, release of energy to release of energy to release of energy.
Yeah. So taking a step back there, are you primarily looking for trades on a daily chart, or is there another time frame that you like to use? And you mentioned, expiration, 69 days out to give yourself time. Um, do you typically like to hold it for that period, or will you trade those and we'll trade it, and may sell it a little bit earlier if it makes a nice move for you?
Yeah, so it's a good question. So if I have an option for 60 days, I really have no intention of holding it for 60 days. It's
Yep.
just more to kind of give myself time so that, if the stock does kind of what it wants to do, then I have time to get out of it. I'd say my default chart time frame is the daily chart. I like that. And then the two other ones I'll use is I do like to look at a weekly chart just to
Yep.
kind of get a little bit bigger view, make sure that I don't want to be I want the daily and the weekly to be they're on the same path there. And then another thing I really like is a 30-minute chart. And it's a good example on something like Tesla right now, where it's just going insane. If you're looking at a daily chart or a weekly chart, it's like, you kidding? I can't chase this. But on a 30-minute chart, you'll get entries and things like that. And so I tend to use that for more, the stocks that are kind of going hyperbolic. But typically that daily weekly combination is great.
Perfect. And I love what you said about them talking to each other, confluence of areas, smaller bases lining up with bigger bases. I think we're in the same frame of mind there. So that's awesome. Um, bring it back to stock selection. A lot of us, as we, a lot of our backgrounds is can slim, IBD style trading, momentum, growth stocks. Is that typically what you're looking for too, or what are some characteristics that you like to look for in terms of deciding, all right, this is the stock that I'm going to be focused on?
Yeah, so I definitely am looking at a can slim kind of based or IBD based. That's one of my core areas. So
Mhm.
the IBD 50, but I'll also look at IBD the leaderboards, relative strength, all the different things. I really like their filters, And then from there, I'll also just kind of look at what stocks are in play. So
Hmm.
an example would be like for Bitcoin, MSTR. I don't
Right.
think that comes up on an IBD list anywhere, but that's one I want to look at because it's in play. But
Right.
I would say, 80% of the ones that I'm looking at are kind of appearing on an IBD list. And then 20% are just kind of, stocks that are just kind of having a moment, but don't necessarily have the fundamentals to back it, according to those filters.
And John, I'd love to kind of walk through some different charts and maybe see what you look for on different time frames to kind of identify, all right, this is a spot where I want to, look to enter to the long side or to the short side.
Sure. Yeah. So I will show you a couple that I just got in this week. And if we look at this, you'll notice, so this is TradeStation, a little bit of an older platform, but I really like their radar screen. So I've got the symbols over here, and then I'll kind of, put in some key sectors and things like that. And some of the key things I'm looking at is, is it in a squeeze? And I'll talk about what that is. And then are the moving averages, are they stacked positive? I'll talk about what that is, and then just some extraneous information over here. But the main thing I'll do on this, and these are just as I'm scrolling through here, these are kind of like the standard sectors, XLK, what are the top 10 holdings in XLK? But what I really like and where I spend most of my time is I'll come down, 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 down. And so now, okay, here's the IBD 50 as of, December 10th. And so CLS is on here.
Hmm.
Now, if I click on that chart and then I'll come over here. So here is CLS. So here's a daily chart of CLS. And so the things I'm looking at are things like, okay, are the moving averages stacked positive? So what I mean by that is I like to use and it doesn't really matter, honestly. It's just, but these are the ones I use, the 8, 21, 34, 55, and 89. And, they're just Fibonacci clusters. They're all EMAs and they're in order of appearance right there. So when I'm saying that they're stacked positive, it just means that the 8 is on top of the 21, which is on top of the 34, 55, and 89. So when you get that situation, you're just getting a situation where, the flow is to the upside. Like
Right.
this kind of crap, there's just, there's indecision there. I've got better things to do with my time. So then when I'm looking for a squeeze is typically it's just a compression of the Bollinger Bands to the point where you get these kind of black and red dots down here. And when you get that, that's telling you it's like, all right, there's this compression happening on the squeeze, and that's the time when I want to get in. And what I'm looking for specifically then are pullbacks near the 21 EMA.
Hmm.
So I saw the stock come up when it was at 95, and then I placed some limit orders on options kind of just above this, and then we kind of came down and got filled. And so I did this, and my daughter has a like an IRA account, and so I did this one in her account. So it's let's see, there we go. I can show you how I structured it. So what I did with this one is that we picked this one up. Yeah, so it's kind of done as a spread here. So I bought,
Hmm.
the in the money call or the at the money call, $90, sold the 110 call against it. So we can kind of benefit from that premium decay. And then what we're looking for then is just kind of a pop that way. A more traditional one, and let's see, here's one that I was just kind of looking at the other one that we picked up here. And this was also on one of the IBD scans. So this is, I would say, a more classic kind of thing of what I'm looking for.
Hmm.
This one had kind of a shorter term squeeze in it, but it's looking good, it's looking good, IBD, and then boom, we get the flush to the 21 EMA. And then that's really why I want to pick it up. All stocks revert to the mean, and typically it's meant to kind of scare people out, weak hands. So the stock's at 58. We bought these $55 calls for $3.39. And for people, if you don't know what options are, I mean, essentially two calls represents 200 shares of stock. And so, if you buy it at $3.39, and it goes to $4.87, then you can see, essentially, uh, it's essentially like having 200 shares of stock. So those are kind of my bread and butter type trades.
Hmm.
One that's maybe a little bit more, kind of in my bigger account. So you have a squeeze here. We came down to the 21 and MSTR, not necessarily something that is on, IBD. It's just more kind of like a, for Bitcoin and things like that.
Stock and play, yeah. Theme and play too.
Yeah. So on this one, this is a bigger account, so I'm doing larger size. But so I'm going with I'm buying these $400 call options that are 9 days out. And then because the premium is so high, I'm selling these $500 calls, for $9, and they're still increasing in value. So it's interesting, one of those things. And so on something like this, my goal might be, it's like, okay, I got this for $21.50, and kind of a target on this would be, could I sell this for $50?
Hmm.
So, I'm not necessarily looking to, hold it like all the way to 500. But the setup on this is the same, where I'm just kind of looking for, all right, we have a squeeze in place with the red dots, and, we came down into the 21 EMA and got a bounce. And so now what I don't know is, are we going to be able to bounce and, retest these highs? Are we going to be able to push through that? I don't know. I just know that the situation, you're typically going to get a good bounce.
Yep.
And so I will then have, kind of, I'm a huge fan of scaling out. Just, hey, you know what? We'll probably get pretty close to this high. That would be a good place to take some chips off the table, trail of a stop, and then, allow kind of the stock to do what it wants to do, but take profits off the table, as the market presents them to you as well.
And for this type of setup, are you buying the tightness action? So as it's pulling into 21 EMA, that's where you're placing the trade, or are you waiting for the push higher off that level like we saw today to then, all right, there's momentum to the upside from the contraction. That's when I pull the trigger, or is it almost a little bit of a mixture there?
Yeah, no, it's a good question. So this is one that's come up on a lot of the IBD lists.
Yep.
So I first saw it when I was up here at 29. And so I just put orders to buy it here. So I didn't wait for any confirmation or anything like that. I'm just like, okay, if this thing flushes, I just want to get it. And when I do stuff like that, it's just simply because I've always kind of thought, a lot of times, like buying stocks more, but especially buying options, it's kind of like buying real estate. And if you can buy right, if you live in a neighborhood of $600,000 houses, and a house comes up for sale for $675,000, you're like, oh my God, I gotta have it. Okay, well, you're gonna have a hard time making money on that house. Let's say a year later, you're like, oh my God, I gotta sell it. Well, if the neighborhood is still $600,000 houses, you're gonna take a bath on that. And it's the same thing I found in stocks, is that if you get these stocks, they have these up moves, and it's like a lot of times, not everybody, but there's a certain percentage of the population, they're going to see this and hate it, but when it's right here, they're going to love it. It's like,
Right.
oh my God, now it looks good. And now I've got all my confirmations. And so they're going to buy it. And the market's very, very efficient about trying to kind of shake those buyers loose. And so I really like when you get a pop like that, just place some orders down here. And the
Hmm.
reason I like to have limit orders in place, good till cancel orders, is that A, I don't want to sit there and kind of stare all day and see if it's coming down. B, if it does start coming down, sometimes you might start questioning, well, maybe I need some more confirmation. And so I have found over time as some of my best trades are ones that I kind of place and almost kind of forget about. And then I'll hear this ding, or I'll come home at the end of the day and it's like, oh my God, I got filled. Now, if it hits here and just absolutely gets destroyed, a lot of times you possibly can work your way out, because a lot of times it'll actually come back up and test that level as well. So the nice thing about options in this case, the option was $3.25. The most I can lose is $3.25,
Right.
even if the stock drops it goes to zero. And so the nice thing about options like that is that, you can kind of position size. So you're just risking the debit. And then that way you're not getting into a situation where if you buy the stock and you have a $3 stop, you get stopped and then the stock goes back up. It's just something where you're willing to kind of hold that risk and let it play out a little bit.
And how do you decide how much risk you'll be taking on any single trade? Does it, I think I saw somewhere that it's typically about 5%, but obviously that depends on your conviction in the setup, and you might size higher if you think it's a better opportunity, better market, what have you.
Yeah, it's a good question. My favorite trades are, so if we come over here and we look at like SPX. So, the first thing I always want to kind of look at is, am I going with the market or fighting it? So, here's
Right.
the S&Ps, obviously they're an uptrend. Some of my favorite trades are when the indexes are also in a squeeze. So if you got the indexes kind of in a squeeze, which typically means like, okay, this thing's going to rip instead of trading sideways. If there's an index in a squeeze and then a momentum stock like a Tesla or Nvidia also in a squeeze, I will go bigger size on those.
Hmm.
Um, Now I may do something where I'll put like say 8 to 10% of my portfolio in that trade. And now, am I willing to risk all 8 to 10% of that? No, I don't want it to go to zero, but it may go to zero, and I accept that. Typically, then on something like that, you're looking for that. The nice thing about these trades is they kind of tend to work out, within a week or two, or they're just kind of a dud. For example, if this does not, when this triggers long, so I like to kind of get in while it's consolidating.
Hmm.
A long trigger is that green dot, and if the momentum's above zero, that's the signal. And then typically it lasts 8 to 10 bars. And then during that time, you're generally uptrending, series of higher highs and higher lows.
Right.
So now you may get something like this, like here's a squeeze and it fires, but then it immediately loses momentum. And that's a situation where you're like, oh, okay, it's just you just get out.
Hmm.
It's not a disaster. You just like, okay, it's just not following through. So that's what's kind of nice about it. And I always say, like, as long as the setup is true, I'll stick with it. And then if the reason I got into the trade is no longer true, I'll get out. And so that's like, so right now, we don't have any squeezes. Obviously, the markets have been pretty frothy, here in December. And so now I kind of dial my position size back because, I think, the markets, they don't have anything setting up. Who knows if we're extended or not? It feels like we should pull back, but we don't know.
Right.
And so just kind of so then in that kind of a situation, it's a little bit smaller size and just kind of waiting for the next index setup to kind of line up with some stocks like that.
Yeah, perfect. And on a stock that's a dud, um, will you kind of cut your loss at a set percentage of the initial, whether it's down 40% the option or down 50%, or it's really just, it's the price action that dictates, it's not working. I'll just take that off and look for another better opportunity.
Yeah, it's a good question there, and I'm going to show you one trade here that I had done a while ago. This is on Google. Okay, so here's one of the hardest trades I've ever held on to because I did it with a lot of size and conviction. So
Hmm.
this is Google. This is back in March of 2021. We got a squeeze, that was setting up here. And of course, this is post split. This is when the stock was, trading at 2000. So I started buying calls here and here and here and here. And if you look over here, here and here and here,
Hmm.
and I'm buying these calls and, they're losing money because not only is the stock, not going up and, the options are decaying, but it started looking pretty ugly. However, during this whole time, the stock never, although it didn't do anything and it was a dud, it never violated it. And so I always kind of look at this little ribbon here. This is kind of minus one ATR, so average true range.
Hmm.
And so my rule of thumb is if we close below that, then the next day I'll look to exit. And so, we kind of would test it a few times. We never closed below it. And I was starting to like, I was down pretty big on this. And then finally the squeeze, fired, and then this turned into this massive trade. And so I've kind of found, if it's a dud or not, like how do you know if it's a dud? And you just want to make sure that you have guidelines as to what a dud is, because if it's based on feelings, it's gonna be like, God, I've given it 3 days, let me get out of here. And so it is for me, as long as the reason I got in is still true. So if I look over here, like, is there still a squeeze? Yes. The momentum's kind of neutral, but it's not like it's falling. And, you're just kind of hanging out, waiting, waiting. Are the moving averages still stacked? Yes. So, you don't know exactly when it's going to go. So if I had cut this loose for a loss, here, and then, this would have been a pretty big move without me.
Hmm.
So, so then, kind of begs the question. It's like, okay, well, what does kind of constitute, kind of getting out and stuff like that. And I know there was another trade on this. Actually, it was pretty shortly after that that I did get out of. So, here's a squeeze, the momentum's going up and stuff like that. And so I kind of buy the pullback, but it was also kind of right in front of earnings. So
Right.
it was just kind of like that was a weird one. But then you can see it kind of took out support right away. So that's the main thing is just kind of what's the line in the sand? What are the levels that you're looking at, that this is no longer true. And I think it's different if you're trading stocks versus options, because if you're trading stock, you don't really have an expiration date, and you could add to it as long as you're not martingaling it. But as long as the conditions are still true, it's okay if it's a little sloppy, as long as you're not getting like some technical break, like on high volume or something like that. But the markets are designed to try to shake people out.
Yeah, perfect. And just breaking down kind of what I'm seeing with the setup that you traded, the first one, if you could maybe go back on the left just a little bit, you had the stock had just broken through the longer term moving average, the green one, whatever that is. It had an expansion move up through that moving average, and then we start to base consolidate. So that's a 200-day. That's what I was thinking.
Mhm.
And then we're basing, contracting, forming a tight base consolidation, whatever you want to call it, right above all the moving averages stacked together. Is that kind of what you were looking for, along with the squeeze? And then, yeah, it's a great setup.
Yeah, no, and it's great. So if you can, so I'm a huge fan of that pattern, also cup and handle patterns. So if you combine that with a squeeze, so that's certainly what I like to look at. And I've just found that they just tend to perform. They tend to perform the most consistently. And so if you find like, I mean, this was kind of another textbook one as well,
Hmm.
where we've come up. It's just you kind of get a base. I wouldn't really say it's a cup with a handle, but you get a squeeze, and then boom, you get your next move.
Right,
And and you kind of start looking at things like, okay, well, what if you get a squeeze here? Is this something I'm going to consider? Well, the moving averages aren't stacked positive, right? So I'm certainly not going to buy anything here. So there are opportunities, for bearish plays as well. But, for me, for a trade to be, I never buy a stock like, oh my God, it's here. It seems to be a bargain. It's just not my style, like Peloton, something like that.
right.
But I want to see that, hey, there's evidence it's above all these key moving averages and stuff like that because there's a lot of stocks out there. And I think at any given time, even in the worst markets, there are going to be stocks, kind of trending higher and making new highs. And while I do also enjoy the downside in the markets, you just don't want to fight that too much. I mean, the markets are designed to go higher over time. And so, yes, there's going to be moments that come up where you get these flushes or, potentially, bigger kind of bear market type situations. And, my rule of thumb with that is like, all right, if we just get, two closes below the 21 EMA, great. If I'm going to trade it, I'll short rallies back to the 21 EMA. I might buy some puts or something like that.
Right.
But yeah, I'm not going to, sit there and just keep buying it when it's telling me that this is not a market that, where there's demand for shares at the moment.
Perfect. And you mentioned earnings just a minute ago. I wanted to ask you what your strategy is around that, whether you would hold a position through earnings or you would just kind of let it go and see if it sets back up again after whatever earnings move happens.
Yeah, so generally, because it's options, I'm not holding through earnings only because, the option prices get really inflated.
Hmm.
So, the last two Nvidia earnings, one thing we'll do is, you'll notice that a lot of times you'll see a stock run up into earnings, and then, a lot of people get excited, and then they buy calls, and then the earnings come out, and kind of wah wah. And that's
Right.
happened the last couple times with Nvidia. But the toughest thing with earnings is that, you may find some like, well, Nvidia that one time went up $100. Like, gosh, if I had some calls on that, it would really work. It's just very rare when that happens. And so I just find that for consistency's sake, I just assume that the market has it right. And that if I buy an out of the money call for earnings, I'm going to lose money. So with options, I will do some things where, you're kind of betting that the people who are buying calls are actually going to lose money and like sell some call credit spreads and stuff like that. But it's more kind of a way to, maybe some ancillary income. I don't really put a lot of risk towards those just because, it's one of those things you wake up in the morning, you're not quite sure what you're going to get.
Right.
And, I think there's more consistent ways to make a living.
For the squeeze setup that we kind of went over, and you've shown a few examples for, what differentiates between an A plus squeeze setup and just your average run of the mill, squeeze setup? Is there stuff like short interest that you look for, the theme the stock is in? What other kind of factors are you taking into consideration in addition to the technical price action or any kind of key technical price action that, also helps differentiate that setup?
I am a fan of high short interest in a stock. You're not going to really see that in like the big stocks. So that's
Yeah,
kind of a more of
the
a
mega
right.
caps, yeah.
Yeah, more of a special situation. But if we look at so this was one in Microsoft, and I wouldn't call this A plus because you can sit there and say like, well, gosh, it was just kind of sloppy and stuff like that. And it was one we took just because it's Microsoft and the markets look good. But if you're looking at kind of a an A plus setup, it's typically on something like this where you get a really good run. Typically, it's off of a squeeze, so like right here. So you get a really good run, and that was an A plus setup as well. You popped up, you consolidate. The moving averages are staying positive like that, and then you just need to catch its breath.
Right.
And while it's catching its breath, you get the consolidation, the moving. It's just not falling, and that's so great. And what's nice about this is that this kind of gives you an idea of like, all right, this thing is, it's building up power, and then boom. So, an example of something that's maybe not as clean is that, if you see a squeeze like this, and it's like, oh, here's a squeeze, this thing could just keep going higher because right here, we don't know the future. But you'll notice that it's kind of like, well, geez, the momentum's just red, and when it releases energy, the momentum's red. Well,
Right.
that's a sell signal. And so that's something that we'll kind of keep an eye out for. And it's like, it's okay if it's red, but before you get into it, you want to see that turn. It's like the
Mm,
momentum is turned. So that's something where it's like it looks promising, but literally there's no positive momentum from the very moment the squeeze started. It's just negative momentum, negative momentum. So that's something that we like to look for. Is kind of a heads up, negative momentum. Yeah, so just different things like that. There was one that we just recently did in Roblox. Um,
we're
this
trading
was
all the same names. This is cool.
that's interesting. Okay. This one, so we had good earnings, it popped up, and then we came back to the 21 EMA. We consolidated a little bit. We had a squeeze, bada boom, bada bing, and that was a fun one as well. Right now, there's not a ton of squeezes setting up just because the markets, have kind of exploded.
Right.
But what I'll do then is just kind of go through here and just say like, okay, well, where are the squeezes? And I was looking through this earlier. Let me see. Let's go through the IBD 50. So this is recent. These are, this is the updated list as of like yesterday. So if we look at something like, CVLT, all the moving averages are stacked positive and there's a squeeze. Okay, well, let's look at that. I haven't looked at this one. And we can look at it and just say like, okay, well, is this one pretty good? Well, and it's not too bad. So you've got, it's been basing, it's above the 21 period moving average. We're kind of squeezing here a little bit. And so the idea on something like this is like, okay, yeah, this is great. It's an IBD 50 stock. It's catching its breath. It's building up some energy. Um, look, and I know IBD is kind of more about like, let's let it break out first. I kind of like to get into it before then
Hmm.
and just give it some time. And so when it does, like in this case, if it breaks out to make new highs, then you're going to have another series of people kind of pouring into it. And so I think it's worth the risk to kind of get in if you've got a setup to kind of get in before that. And then oftentimes what I'll do in a situation like that is that initial momentum where it's breaking out, which attracts a lot more money in, that's a good time to like, maybe sell a third of your position. And then that way
Hmm.
you've kind of, cashed in some chips and reduced your risk on that when that happens.
And when it's tight enough that it looks ready to you and you look to buy, does that also is are the options cheaper at that instance than when if you actually did wait for the confirmation, they'd quickly, be rising? Is that another reason why you do that?
Yeah, that's a great question. The challenge is on something like this that let's just say, I mean, there's no squeeze here, but let's just say you decided to buy some calls right here.
Right.
Well, the what's called the implied volatility is going to explode. And so
Right.
you're really literally overpaying for the options. And so, whatever you pay, let's say you bought let's say you bought the 175 calls right here. Well, you overpaid for them and now it's going sideways. So even here, when the stock, kind of recovers, you're going to be underwater because, those options you overpaid for them and it's a depreciating asset.
Right.
And so, but over here, if you kind of get in, and I always like my rule of thumb is get 5 red dots. Well, it means it's a quiet stock and you're kind of not only are you getting into the stock at a good time. You're getting into the option at a good time. What I love, so it's a kind of a nice, you don't really have to know a lot about options, but essentially if you wait for that setup, you're buying the options correctly because you're getting it when it's quiet. And typically, the premium has come in and there's no excitement around it. And then the benefit of that kind of pop in price is not only are you benefiting from the intrinsic value, but the implied volatility also expands. And
Right.
so, and so that's kind of a double win right there too.
Perfect. And taking it back to the very basics, say you were looking to enter this one, what how would you kind of decide the strike price? How do you decide the expiration date? How do you kind of set up the actual trade with the option?
Sure. No, it's good questions there. So let me back up here a little bit on it. So we can kind of look at the stock and just say like, it's been in a pretty solid uptrend. And if we're going to come over here and look at the options, so CVLT. And so, my assumption on this is, we're not going to see anything too crazy. And I generally, if I'm going to go in on a daily squeeze, I want to give myself at least 30 days.
Hmm.
So at the very least, I would come over here to 37 days out. It's okay to go further though, but let's go to 37 days out. Now, one thing that you'll notice here, and this is, I think, where a lot of people get nervous. There's not a lot of activity in these options. And this is something I've noticed with a lot of IBD stocks because they're not the Microsofts of the world and stuff like that. And so sometimes people will look at this and get scared. It's like, oh, because there's a lot of option books out there that say, no, don't trade stuff like that. Compare this to, say Tesla.
Right.
And Tesla, if you go and look at these options, the let's get closer to at the money here. Um, you know, 24,000 contracts, volume and stuff like that too. And then if we go back to CVLT, it's like, okay, what's happening here? Personally, I've traded plenty of stocks where there's sometimes I'm the only open interest. It's totally fine. And the downside of it is that it is a little harder to get out because the spreads aren't as tight.
Right.
But the upside of it is that, I like these stocks that trade 300,000 shares because when they do have a big day, it's kind of exaggerated.
Mm.
And when you're right on a trade, illiquidity is your best friend because the moves get a little crazy. If there's a lot of liquidity, with Tesla being an exception, but you'll see, a very liquid stock, can go up $3, then come back down, and there's all these things happening. There's all these huge institutions trading it, but here it's just kind of like, oh, it's ready to go,
Right.
and it's just going to go. So what I do on something like this then is, if we're at 173. Generally, if I'm just going to buy a call, I'm going to come over here and just say like, all right, well, what are the prices? Well, the 170 calls, you kind of split the difference. So it's like $9.
Hmm.
So if you look at that, basically, $6 of it is premium and then $3 of it is intrinsic. And the best way to think about that is that in 37 days, if the stock doesn't move and you don't sell it, this goes to zero, and all that's left is going to be the $3.10. So
Right.
I do like to kind of structure it in a way to kind of recognize that and say, all right, so if I'm going to go to if I'm going to buy the 170s, I'll generally then just kind of look at like, okay, well, what's priced in? Well, what's priced in during this time is a $16 move. When there's a squeeze, typically you're going to exceed that.
Hmm.
So I will then typically go, all right, I'll get the 170s and then go $20 away from that to the 190s. And now I can sell that against it. And so that will then kind of reduce my premium. So if I was going to come over here and just say, like, all right, I'll buy the 170, I'm going to sell the 190. So now I've got a $7.37 option where about $3 of it is premium and then $3 of it is intrinsic value. And, on one contract here, you can see that my max loss would be $7,300 and my max profit would be $12,000. It's not an all or nothing. That just means that's the worst and best case scenario. Typically, I'll risk about half that. And
Hmm.
then, your target is also, on something like that. I typically, if I've got about a $20 wide strike, I'll typically say like, three-quarters of that as a target. So $15. So I like that setup just because, you can kind of sit on a stock. You're not getting slaughtered by premium decay. Obviously, you could sell some put credit spreads too. If you're, if you understand options, you could do that and get what's called a theta positive
Hmm.
position. So you're just collecting premium while you're waiting for the stock to move, and I'm a fan of that as well. And then, but yeah, I think the mistake is to come in here and buy these, $200 calls and hope for the best,
Right.
because you could be 1,000% right and lose all your money. So just things like that, where you just want to, you want to play what I just call. I like to trade options in a way that I'm just getting the stock for a cheaper price. I'm not trying to, um, you know,
Go crazy. Yeah.
go crazy or like try to do something that has pretty low probability of working. And so yeah, you sell the ones that are probably going to expire worthless anyway. And then if it does explode, okay, so you capped your gains a little bit. That's okay.
Yeah, this is great. I wanted to dive back to what you said way earlier. We've kind of talked right now about a daily squeeze setup and how you kind of position and that way. You mentioned, Tesla obviously on a daily isn't set up for a squeeze because it's right now expanding, but on an intraday, there are some spots that you could look to trade within that. So do you mind kind of walking us through the process and how you might structure an intraday trade like that?
For sure. So, oops. Tesla. Okay, so Tesla, obviously this thing is like going insane here, right? So
Yeah, new all-time highs.
new all-time highs, it's this is probably gonna be $1,000 stock in 2 years, and Elon's probably gonna be the first trillionaire in, in our known history. So, so what I'll do is like on a daily chart, it's really hard to get excited about buying right there, right? You feel like you're making a mistake. So if you go down to a 30-minute chart, what's going to happen is 30-minute squeezes are going to be developing all the time. So
Right.
here is a beautiful 30-minute squeeze. Everything we just talked about applies here too. It's just a 30-minute chart instead of daily. Another beautiful 30-minute squeeze, and on a daily chart, it looks insane. Another 30-minute squeeze, and this was at like 400 when it seems. So would I buy it right now? No, I'd want another 30-minute squeeze.
Right.
And I don't, 5-minute squeezes and all that. I mean, now I don't know. I think, you can save yourself a lot of angst if you just stay 30 minutes and above. The 5-minute chart, let the computers and the teenagers trade that. And then I'd rather make one trade. If your goal is to make $1,000, I'd rather do it on one trade than 10 trades. So, 30-minute chart in this case, you can set up a position, you can be in it for a couple days. You're not, having to be a keyboard cowboy or anything like that. And then just wait for the next one. And it's when you see something like this, you don't have it, it's easy to get FOMO. Just wait for the next setup. I promise there will be another one.
And for this one, how do you structure the trade? Do you do it any differently? Or are you also buying 30 days out, or are you doing, daily expiration, something like that?
Yeah, so kind of the same thing. So this stock, it's going insane, right? So this one I remember I did a combination where I bought next week's 350 calls and they were pretty pricey. But then I also sold a put credit spread and bought a call debit spread.
Hmm.
And so, and the reason I do it like that, so let's say I have, I'll just make it for ease. Like, let's say you have one 350 call, and then you have one, 350, 380 call debit spread, and then you might have, one 350, 340 put credit spread. Okay, so so you got call debit spread, and then put credit spread. Okay, so why do it like this? Generally what I'm looking for is, once you get that squeeze, you get that little pop. Well, I'm getting rid of the call. That's the one that's got the most risk. That's
Hmm.
the one that is gonna, kind of get the hurt the most if the stock drops. So boom, great. Scale out. Then you can give these a little bit of room. What's great then is if your call debit spread actually, if it goes through the debit, like if it goes through 380, well, you can just kind of hang on to it because every day that it's above 380, you're making money, in the premium decay, and that's kind of up to you. And the same thing with the put credit spread. So these two are more forgiving, but I like to structure it like that because you kind of get that little pop, take some profits on it, and then you can ride it a little bit more with something like this. So, and there's other ways to do it too, but those are the basics of kind of what I like to look at.
And do you position size these any differently than a daily squeeze trade? Are you sizing these less, more? How do you kind of go about it?
Okay, that's a great question. So I actually use the same position size.
Hmm.
And what I like with it, and so I'll use a little bit shorter time frame, same position size, so it can be a little bit more, a little bit hairier. But the difference is I will take some chips off the table quicker.
Right.
So, on a 30-minute chart, typically you're only in that trade for a couple of days anyway. So on a daily chart, I might wait, once it fires, I'll just kind of sit on it 4 or 5, 6, 7 days before I do anything. But on a 30-minute chart, typically the average squeeze lasts 8 to 10 bars. So on a 30-minute chart, that's basically an overnight trade. So
Right.
if you get it and then the next morning it's taken off, you're kind of getting out of the trade depending on how you structured it. But I'll use the same size and just get a little bit more aggressive on the exits.
Yeah, perfect. And what I want to ask was, oh yeah, yeah. So I remembered. Typically, are you trading more this type of setup, or are you only really looking for these intraday trades when we're in a situation right now where a lot of stuff is already expanding, already in a short-term uptrend, and there's not a lot of daily pops or sorry, daily squeeze setups? Or is it, you're always looking for kind of stocks and play like Tesla to take advantage of this while you're also swing trading, other stuff?
Yeah, no, it's a great question. So for, a stock, if a stock is meandering, which I would say, except for the last couple days, Microsoft's been kind of meandering a little bit. A 30-minute squeeze isn't going to do too much, and so I'm kind of ignoring it.
Right.
Um, and then, yeah, I don't know why this is not coming up, but we'll give it a second. But, really, yeah, here we go. So 30-minute squeeze, if we come over here, so you can see like, okay, so when Microsoft was just kind of hanging out here on the daily chart, it wasn't doing much. These squeezes aren't interesting.
Hmm.
It's just, but once you get once Microsoft kind of broke out, then it does get kind of interesting. But even, like a Microsoft, you get a squeeze here and it's like, okay, it goes from 445 to 447. So it is, Microsoft is just really isn't a stock that you see having these huge moves. So I typically then I'm just going to wait on a daily setup for a Microsoft. If there are stocks that kind of, and a way to do it, a way to look at it too is, so if you look at Microsoft, the average true range on the stock is $7.70.
Right.
So, and then, the beta is like 1.3, which means that, okay, it kind of moves pretty close with the S&Ps. If you bring up a Tesla on this, and then we kind of look at the average true range, and then, yeah, you'd think that this would be super fast right now because the market's closed. But if we look at the average true range, it's like, okay, well, the average daily range is $17 and 60 cents. And then the beta, it's not on here, but it's a multiple of the S&Ps.
Right.
So that's what we're kind of looking at is, it's like, okay, these, Microsoft and Tesla are kind of the same price, but the average, daily range of Tesla is like 2.5 times that of Microsoft. And then of course, it's just you just kind of have this crazy move. And I'm a big fan. If you're not sure, let me put on, let's see, RSI. One thing to look at too is that if a stock is overbought, that's actually kind of a good sign. Typically you'll hear like, oh, overbought, you got to be careful, all that kind of stuff. But look, a stock that's in demand is going to be overbought. And
Right.
so, typically on something like this, and I'm a fan of IBD, like they have the new highs and relative strength. I mean, I think that's a good thing to follow. But if a stock is, typically overbought, it's like, oh gosh, is this thing, I better stay away from this because I read once that overbought, is bad. But you actually want to see a stock that's overbought in this situation. It just means that there's such demand for the stock that it just keeps going and going and going. And so when you find stuff like that, you're not afraid of it. It's just that you just drill down to the 30-minute chart and you just play it off of that.
Right. And on any particular day, and obviously it probably depends on market situations, all that, but on any particular day, how many stocks are you usually focused on, have alerts set, are actively ready to go ahead and execute?
It's a pretty small amount. I found that I would rather, if I've got a portfolio of stocks, and typically if they're all option trades, 5 to 7 is kind of a max for me.
Hmm.
If I got like 30, I'm just going to go insane. So it means I'll miss a lot of stuff. But what I like to do is generally, I'll have kind of the usual suspects that are like right now. You got MSTR and Tesla. They're kind of moving, so I'm gonna have them front and center. I'm gonna look at the indexes,
Right.
and then I'll just go through the IBD list. And now I may have at any given time, say 10 orders to buy pullbacks in those IBD stocks. And then, if three of them get hit one day, I may have to consider canceling some of the other ones. But I do like to go, I just call that fishing. And so that's something that and I always kind of found like if you can do two well thought out, well planned trades in advance, that's so much better than, 20 off the cuff, like, oh my God, what's moving today.
Right.
So I don't mind working a lot of orders, but I'm not a huge fan of managing a lot of positions. And
Makes
so,
sense.
I try to keep things fairly simple that way.
Yeah, that's great. And maybe bringing us back to a higher level, talking about your daily routine. Could you maybe walk through kind of what you do on a typical day to get ready to trade? Starting from, when you start your prep in the morning, if you do it all in the morning, all the way to the end of the day and a little bit after the day to get ready for the next trading day.
Yeah, I would say I used to do a lot more prep, and then I found, the amount of hours that you put into prep didn't really help to an extent. If you look at 1,000 charts, is that going to make you 1,000 times better? So what I generally will do is, kind of do a quick like look at the indexes, maybe look at the Mag 7, kind of get a sense of what the indexes are doing, and then, kind of go through that radar screen where I'm looking, okay, what IBD stocks are in a squeeze. And then from there, it's really just kind of a sense of, I will sit in front of the computers for part of the day. Is this something where, are the markets going to trend higher today? Is it going to be a walk down day where they're puking and stuff like that, just to kind of get a sense. But I'm a huge fan of getting away from the market. So generally during lunch, so we'll have a trainer come to our house one day, like today was strength training, and then the next day, like a yoga instructor will come over.
Nice.
And so what I've found with that is that for me, like I won't leave the computer because I like, watching the markets is fun. But the shame of sitting at my desk while someone is waiting for me, out in our garage, that'll cure that. And so that's been a great way just to keep my mind clear, stay in shape,
Yep.
and stuff like that too. But yeah, so it just kind of depends. And here where I am right now, I mean, I've got like six monitors and a laptop, but I've also found when I'm on vacation or we're like at the beach and I just have a laptop, that's fine too. So I think it's a really important to kind of you don't need to know everything. There's a saying like if you're surfing, you can have fun catching a couple of waves. You're not going to be depressed because you didn't touch all the water. I think it's the same thing in trading. Just kind of find your niche. Don't get FOMO, fear of missing out, if all this other stuff's happening that you're not involved in, and just kind of find your groove because I think it's easy to get information overload in this business very, very quickly.
Are you saying, John, you don't need 12 monitors to watch every single thing to be successful? You
It,
just need one?
it feels like you do, but I think at the end of the day, if it was, if I had a laptop and I just sat there and said, okay, well, I got the S&Ps and these two stocks, you can make a living doing that. And I know, a lot of traders that have been doing this for 30 plus years, a lot of times they just trade one thing. Typically, it might be the S&P 500 indexes, but they've got their three setups. They wait for that. They don't really care what else is going on. And the main thing is they're, pulling money out of the markets. And if your goal is to make $1,000, it really doesn't matter if you make it, trading ExxonMobil or trading Tesla. It's irrelevant. We feel like we want to be involved in all these different things, but at the end of the day, our goal is to have an equity curve that goes from the lower, left of our screen to the upper right and make money from the markets. That doesn't mean you have to know everything that's going on. It doesn't mean you have to be right about everything. It's just, were you able to extract money from the markets? Yes or no? And, you can do that on, there's a saying I heard once, and I completely agree with it. If you get one chart of whatever it is, Microsoft, and you have one indicator in one time frame, and that's the only thing that you used over the course of a couple of months, you can make a living the rest of your life,
Yep.
trading that. So, it's easy to get overcomplicated, and at the end of the day, it's simple is better.
Yeah, and I know you've been involved with trading education for a long, long time. Is that a common mistake that you see newer traders do? They're trying to add the RSI, the MACD, the Squeeze Pro all at once on three different time frames to try to get some sort of certainty when really it's about keeping it simple, focusing on the price action, focusing on one indicator, like you said, one time frame, and just trying to execute as well as you can on the setup that is in front of them.
Yeah, and I've had people send me charts where I can't even see the price bars. There's
Yep,
so many things on there. And I joke with that is like, it's like, look, you don't want to be a confirmation whore. By the time all your tools confirm that it's okay to get in, you actually should be getting out, kind of a thing. But there are different styles of trading. And so I think it's important to kind of identify what suits your own personality. The two styles of trading I like the most are kind of what we've been talking about here today. And then I'll do a couple of day trades, and it's more kind of the intraday rotation that happens like in the S&P futures or the SPX. And so it's a different set of tools for that. But I think it's just at the end of the day, it's just finding, are you a levels based trader? Meaning, okay, I feel comfortable placing orders at levels to buy and to get out, or to short and to cover. Okay, great. Well, then you're going to focus on that. Do you like the oscillations? And I find is that, people tend to kind of gravitate towards one of another. Some people like to buy breakouts because when you buy a breakout, everything looks pretty. All the confirmations are there. But just make sure you're trading a market that rewards breakouts. If you buy breakouts in the S&P 500 futures, you're going to be dead most of the time. But if you buy breakouts in Tesla, right, you're going to be rewarded. And so if you like breakouts, find a stock or a market that also does that. If you like reversion to the mean, right? You don't want to probably try that in Bitcoin, but there are plenty of stocks out there that revert to the mean all the time. And so, kind of find out what you like to do and then kind of find the markets that work best with that style of trading.
for sure. And you mentioned Tesla there again, and speaking of Tesla, I know, and I've written the kind of write up that you did regarding 2020 for you, which was an exceptional year for yourself as
That
well
was a
as
good year, yeah.
for Tesla, of course. And I know many who trade, our style momentum IBD had a fantastic year that year. I wanted to touch on a few things regarding that year, and I'll link the write up that you did, which I think was excellent, and every trader should read down below. But what stood out to me, um, yeah, what really stood out to me is the volatility that you experienced in your account that year. Would you mind kind of talking through your thought process with regards to dealing with volatility, stomaching drawdowns, making sure you're sticking to your process, and also I want to talk a little bit about how you consistently kind of wired out money from that account to obviously invest anywhere to lock it in, all of that. So yeah, maybe bring me back to that year, kind of discuss what happened and give a brief overview of your great analysis that you did in that article. That'd be great.
Sure. Yeah. And I remember it was an interesting year, and that was lockdowns, right? My wife and I were in India in February of that year at some retreat. I'm a member of YPO, and they had this thing where it's like a 1 week crash course for executives on the Bhagavad. And so like, oh yeah, let's go. And I remember on the plane, are we supposed to wear masks and stuff like that?
Right.
And so it was this crazy year, and we get back in March. Of course, it's a total shit show, and I like markets like that, so that was fine. But you can't take a lot of risk in markets like that because it's just the volatility is so high. So you're trading small, and then things kind of settled in, and I remember I think it may have been June, maybe it was May, maybe it was June, but it was kind of like $1 million trade in Tesla, and it's like okay, the momentum's coming into this market and things like that, and there are these times in the markets where sometimes it feels like, you have a balance, whatever your balance you're trading. And I'm a huge fan of wiring money out because otherwise it can become this video game. If you say you have $100,000 and every time you get to $130,000, you get a little crazy and it's house money, and then you bring it back to 30, back to 100,000. That happens a lot with people. Well, next time you get to 130, wire out 30 and then start again at 100. And so that can be a way, to kind of psychologically overcome any money blocks, but also, it's also showing you that what you're doing is real. This isn't a video game. This isn't
Hmm.
about like, let's see who can get the highest score. And so, for that particular year, I do think that, you pull money out and you put it into things like, whatever floats your boat. Crypto, I like rare coins and gold. I like, real estate, and the first time I'd made a big trade in Tesla, we bought some land out in Wimberley. And so, just kind of started adding to it as parcels came up. So whatever's fun there. And I just remember that year, it just really started, I started getting a cushion too. And so I will take a little bit more risk if I get some cushion. But there will be times when it's like, things are going good. And then because you're trading bigger, you can get whacked. And it's important to be able to step back from that and to say like, all right, my P&L, my curve is still going up. We just had a pullback here. And it's just important to kind of stay present. And I
Hmm.
do think that there's moments like that, especially when you're talking about numbers that are bigger than you've ever seen. Um, that you're not really used to it, then it's you really gotta and I'm a huge fan like go for a walk. We had horses at the time. I would go out and kind of sit with the horses and stuff like that. But you just got to reset your brain. And what'll happen is over time is that, when you first maybe lose 20 grand, you could throw up, but then the next time it's like, you just kind of get used to it. But over time, you kind of have to build up your intestinal fortitude. And in 2020, I was working with numbers that I hadn't worked with before. And so I was experiencing these new levels of, okay, is this something that what does this mean? All of a sudden now I had a $1 million account. Now it's 10 million. Okay, let's wire some money out. Now it's bigger. And it's, you just want to, as a human, this is new information that you haven't
Yeah.
worked with before. And, if you're a fund manager, it's just like, well, it doesn't matter. You're doing your job. You're trying to crank out your 1% or 1.5% a month, and new money's coming in all the time, and you're kind of locked and loaded. Um, as an individual trader, though, I mean, these are things that kind of can change things. It kind of can mess with your psychology if you're not present. So the whole key with this, and Mark Douglas would do this with me, is just like, okay, John, you need to close your eyes, count from 1 to 100 and then backwards from 100 to 1. It's going to take you about 12 to 15 minutes. And then you can open your eyes again, and then you'll be back to being present. And that's the whole key thing. Because if you're not present, your system gets hijacked. Your nervous system gets hijacked by whatever is in, whatever we have in our bodies that protects us from fear and stuff like that. It can take over and cause us to do really stupid stuff. And so, um, a couple of people had asked me about it, and so I'd spent like a weekend putting together that article just to kind of really try to take an honest look at, look, this is the shit that came up while I was trying to
Yep.
deal with this. And it can look like, oh yeah, there was this great year, no problem. But it is something where it's like, it is kind of the trials and tribulations of a trader. Now, you can trade without that, and it just means you trade smaller and you trade more conservatively. That year I could have been like, oh, I had this great year, I was up 23%. That's awesome. Well, that would have been a much calmer year. I wouldn't have
Yep.
had, probably the same ups and downs, but that was it was a year where you 10x your account. And, there's a lot of things happening. And, there's as a trader, one of the most common things you hear is like, oh God, I took, 20 grand, I ran up to 400,000, and now it's back to 20 grand. And so you don't want to do that, right? And so it's like, oh, I'm making all this money. Well, do I stop? Is it enough? Well, I want to keep pushing it, but I don't want it to, I don't want to be that classic story. So all that stuff's kind of coming in together. And then at the last part of that too is you want to take advantage of the market that you have. And the reality of it is once every couple of years or over the course of any given year, there's maybe 2 days every quarter where you have the opportunity to make these really big gains. And so
Right.
you just have to be there. You have to be there. You have to be present to win. And you just want to make sure you're not trying to extract these huge gains from the market when the market isn't playing that game. Sometimes the market's just kind of, dead in the water. And so you just want to be conscious of that. And, in 2020 was this remarkable explosion of, economic activity in the tech stocks. And, you just want to recognize like, okay, this is not going to happen all the time. So let's take advantage of this.
Yeah. And I think one month you're up 200, maybe 300%, then the next month you're down 33%. I know me personally, I can't handle that volatility. So, yeah, any thoughts or recommendations for people to help, stomach, maybe it's not that same level, but, stomach that volatility so they can stick with the process and focus on, trading their system, whether it's the volatility that you experience or maybe less so some, a typical growth stock trader.
Yeah, and so of course, since I was using options and leverage, the
Yep.
volatility was, probably insane,
Yep.
um, compared to like what people are used to. And I think that that's just something as a comfort level where, look, if you're doing options and you're up 100% 1 month, there's a saying I love this, and it's like the price of 100. So refers to Bitcoin. The
Yep.
price of 100x is you got to be able to withstand 70% volatility. So that means like, if you're going to be a long-term holder of Bitcoin, the idea that this thing's going to go up 100x, of course, this was a while ago, the price you have to pay is 70% volatility, meaning that those are the drawdowns that have to happen if something's going to go up 100x. So I was aware of that, and it's like, if you have a month where you're up 100% and you're still taking risks to try to do that again, the idea that you're going to have a drawdown that's pretty significant, but as long as it doesn't exceed that, right? So you just got to see what your cutoff is. It's like, okay, well, if I made 100%, at some point, you don't want to like give it all back. So, you kind of have this. I'm a huge fan of like a trailing stop loss on your portfolio.
Right.
Um, and that, different ways to do it. But the main thing with this is just do which, I would say just do what you're comfortable with. I think it's okay to push your size. If you normally trade 1,000 shares, try a trade with 2,000 shares. See what that's like. Okay. Does it freak you out? Great. Go back to 1,000 shares. But now that you've experienced that freak out moment, trading 1,000 shares is going to be a little bit easier because you kind of just expanded, what you felt was uncomfortable. And so part of that is just kind of getting used to that. And I think at the end of the day, you just got to be really realistic. Like, okay, what is it that's going to tell me to get out? Because the worst thing you can do is just, close your eyes and keep adding to it. That's how you destroy yourself. It's just like, oh, it's not working. Sucks that it's a 30% down month, after making 100%, but are you still, are you following your plan? Yes or no? And in that situation, it's yes, but it doesn't mean it's going to be easy.
Yeah. And this next question is kind of one of my favorites to ask to every single person, every single trader I get to chat with. How do you personally define risk, and would you describe your risk management system?
I will say that I think from talking to people, and even my wife mentions this too, is my tolerance for risk is pretty high. And I do think that just over time trading, you do kind of, your intestinal fortitude just kind of grows,
Yeah.
meaning that you can just kind of stuff that may, knock another person unconscious or just like, whatever. It just builds up over time. And I think that if I don't want to get too far off your question, but I think the idea with this is that if you're trading and you're don't have any, you're very neutral about it. It's good, but you might be trading too small.
Hmm.
So that's one thing to look at it. If you got $1 million and you're trading 100 shares, is that going to really have an impact on your account? And so I think you want to kind of find, what's the frame of mind that kind of works best for you. And I do think it is kind of having a neutral state of mind, but with an attitude of growth. And growth
Hmm.
can also mean expanding your size. Now, I do talk to people that'll trade big size, and they're not worried because they trade like very like far out of the money option. So it's like, okay, if it doesn't work, I'm only going to lose 1%, but if it does work, I could make 10%.
Right.
So there's different ways around it. But I would just say at the end of the day, the main thing is that you know 2020, the opportunities like that come along once in a while and you want to be prepared, but it's not the norm. And it's really just, Tesla being a good example. I was still trading the normal setups that I like in Tesla. It's just that Tesla was having these explosive moves and I was scaling in bigger and bigger size. And so,
Yeah.
all of a sudden when you're doing 500 contracts instead of 100, yeah, the winner is going to be bigger, but then, also the downside. But I'd also say just get very clear on what your goals are in trading. And if your goal is like, look, I just want to make a consistent income, great. Well, you don't want to have the months that are really stressing you out, right? Um, but if you're like, well, I really want to push it and instead of having, trading a $100,000 account, I want to trade a $500,000 account or whatever it is, and then I will calm down and go back to trading income. And part of that is just recognizing, the opportunities that are there. And you can structure trades in your portfolio in a way that if you're wrong, it doesn't have to hurt too bad. And I think the classic way to do it in this market, I did this yesterday, is that I had four IBD stocks going into the CPI, and I thought, well, what if the market kind of, the S&Ps are down 50 tomorrow? So I bought some cheap out of the money puts. Okay,
Hmm.
those went to zero. But and the portfolio did fine. But I was able to sleep well at night because I know if the next morning the market, went to shit in the handbasket, it's like, okay, my portfolio is kind of would be okay. And so I think it's things like that too, just to kind of take advantage of, especially with the zero DTE stuff. It's kind of cheap insurance that you can use.
Yeah, excellent. And I wanted to ask this question a little bit earlier, but I just remembered it. What size account do you now like to trade with? And because you've mentioned other things, real estate, that longer term account, obviously your accounts for your kids, that type of thing. What size account do you like to trade with now? And how has that kind of changed over time, as a percentage of your net worth? Earlier on, did you trade more of your net worth versus now it's a little bit more conservative? You're still trading aggressively, but just with a smaller portion size.
Yeah, it's a good question because it's hard, you want to find an account size that's interesting. And and it's certainly been fortunate over the years in trading, other investments, and I've also kind of diversified from trading where, probably my largest account right now is, it's actually it's an index fund, and you just put money in there and not worry about it. So the two account sizes I like to trade are small accounts of like $10,000 because I do that with my kids. And I like the challenge. It's okay, let's try to get it to $25,000, and that's to me is fun.
Yeah,
But then from there, it's kind of the seven figures, and generally I find like a $3 to $5 million account to take advantage of some trades and generate income. But I mean, we got a ranch with like zebras on it. They're more expensive than I assumed that they would be, and so it's like, yeah, let's get some income to make sure that we can buy pellets and we can do stuff like that. So it's just trying to, and it's finding that kind of, fine line of, are we just, is it just trying to make income or trying to do, any bigger trades and things like that. But, um, yeah, so I think it just depends. Like,
yeah,
I think frankly, the next couple of years, we're going to see some more opportunities like 2020. Certainly, volatility, pullbacks, and all that kind of stuff too. But we're going to see an expansion in valuations in some businesses. And my overall thought process is we're kind of entering the roaring 20s. We all know how the roaring 20s ended, in 1929. And I think we may mimic something like that. And so, you want to take advantage of it on the way up and then prepare yourself if, in fact, toward the end of end of 2029, we get something similar to what happened then.
yeah. We'll see what happens. Should be interesting, whatever occurs. So that should be
For
great.
sure.
John, this has been really, really great. I just have a few kind of wrap up questions here. First, as someone who's been doing this for, 3 decades now, what are some key principles that you would attribute, consistency, longer term success? Because obviously at traders, we think short term a lot, but we all want to be doing this for decades and decades and decades to really take advantage of compounding. So what are some kind of key principles, words of advice for traders who want to set themselves up for success and have a long career, long successful career with trading?
Yeah, it's a good question. And I think the trickiest thing as a trader is that, and I'm the first, and I could get guilty of this too, is that a lot of times we think that the trade we're in now is the one that's going to make all the difference in our lives. Like, okay, this is the trade. This is the big one. This is the
Hmm.
one where I'm going to be able to double my account. I'm going to be able to quit my job. And you've got to get that mentality out. It's poison. It's just, this is a setup. I'm doing the setup. I don't know how this is going to turn out. But I can control my risk on this trade. And so a big part of it is just kind of, and it's odd because, we're all trading. I trade because I like it, but I also want to make money doing it. And I don't think there's anybody out there going like, "Oh, I just love the trading part. I don't want to make money." We want to make money. But if you're really focused and nervous about making money, you're not going to make any money consistently. And so I think the best thing, and Mark Douglas showed me this, he's like, keep track of your trades in blocks. And he suggested if you're a shorter term trader, do blocks of 25. At the end of 25 trades, did you make a profit? Yes or no? And the important thing with that is to make sure that you have a plan and you're following it. Okay. Oh, squeeze stacked EMAs. I bought the pullback to the 21 EMA. At the end of doing that 25 times in a row, did I make money? Yes or no? If you did, you have a sustainable thing that you can do for the rest of your life. If you didn't, you now can go back and say, well, what did I do wrong? And be honest with yourself. Well, okay, I chased that one. I got shaken out of that one. So, but once you start seeing a plan take shape, that's really the most important thing. And I think anytime that you panic and chase, it's like all dogs that chase cars eventually get run over. Just, take a deep breath. That's one thing my dad told me. I remember missing this trade in Micron Technologies, when I was a senior in high school, and he just laughed. He's like, the market's going to be open tomorrow. Don't worry. So
Yep.
just kind of take a deep breath, get in a groove, and this is something you can do long term.
Yeah, excellent. Well, John, thank you so much for your time. Where can people learn more about your style? What other resources would you recommend? Obviously, we'll have links to simpler trading down below the description. But yeah, is that the best place to get in touch and access more resources?
Yeah, so our kind of the hub is simpler trading. In January, I'm planning to launch an alert service for small accounts, kind of using just what we talked about. That'll be fun. I'm looking forward to that. It's something I've been working on with my kids. I am on Twitter, just at John F. Carter, and that's where I kind of do more trading related stuff. And then, yeah, I mean, my email is john at simplertrading.com. If I do go through and kind of am curious about, what people are asking and stuff like that. And that's kind of where we hang out. We have a trading room where we kind of hang out and talk. And yeah, otherwise it's like, in between working out and doing yoga, typically I'm, looking for the next setup in ideally Tesla or MSTR at this point.
Yep, we'll see. We'll see. Well, thank you again, John, for your time. To everybody watching, hope you guys enjoyed as well. Make sure to leave a like down below, subscribe to the channel, and check out the resources that John mentioned in the description. So with that, thanks so much for watching, and we'll see you guys in future videos. Take care.